Okay, the markets finished the day with a little bit of a down note. Nothing too significant. There is a little bit more of signs of weakness showing up in the Dow Jones Industrial Average. I am going to show that. And then we saw some interesting patterns, kind of a little bit of a risk-off day when you look at today's move. Kind of a continuation of a pattern we've seen over the past about 5 or 6 trading sessions where gold has really taken off to the upside and yields have dropped down significantly, relatively significantly, and to the point where we've seen a little bit of a risk-off move among these U.S. sectors and a little bit of a rotation away from these large cap, mega cap names. Even inside of the Magnificent Seven, there's been a rotation towards one small, narrow segment of that area. And away from the other more traditional names in that space. We'll break all that down in today's video. I'll show you all that that I'm talking about there. See some of the moves that we're seeing in yields and the dollar and some potential support that they're sitting on right now. We'll see how that impacts where they're expected to go and how that might impact a pretty overbought market right now. And then our trade idea we'll take a look at in the healthcare sector stock that is looking like it might be breaking out of a multi-month sideways trend. And we'll talk about how to trade that. So let's go ahead and get started. Today is Wednesday, March the 6th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Hey, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website on MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live video. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click on this thumbs up icon. It opens up this tab, hit that like button. Again, the more you do that, it helps get our content out to all of our followers on those platforms. Our goal is to get to 100. So thank you to those who do like this day in and day out on these platforms here. Those who don't, you can do it right now while you're watching with 1 or 2 really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicators. You can see the near-term line is down into the bearish territory again for the 3rd time in as many weeks. Really, you can go back probably like the last 5 weeks and see. Actually, it's probably, let's see, from March the 6th back to, a little bit more over a month. We've had almost five drops down into bearish territory in the near-term line. Not one of them dropped into the reversal zone, even though 3 of them, the momentum line did, dropped in. This one did not. So again, unlikely it's not guaranteed that it will drop in there with it. It's unlikely it will drop in there without it. Usually the momentum line's got to get down there first. So this suggests that especially the bounce that the momentum line's already crossed up above the near-term line, suggests that the near-term line will bounce up too here pretty soon. The intermediate line still above the 90th percentile. Market sentiment still above the 80th percentile, though both are falling. But again, it doesn't really matter when you're in the upper reversal zone. The intermediate line is up above the market sentiment line. And you can see the cluster that we got. We still haven't exceeded that cluster there. We're still trading slightly underneath and slightly underneath that 2.5% mark above the 30-day moving average, only 2% above there. Looking at the NASDAQ 100, again, most of these NASDAQ 100 stocks not doing so hot. The intermediate line and momentum line dropping. The intermediate line, though, still is above market sentiment. The short-term sentiment looks very similar. The momentum line did dip its toe in the lower reversal zone, but bounced and is now above the near-term line, which also got into bearish territory, but again, not to oversold levels. So again, we'd expect that you'll bounce off of this. The Dow Jones Industrial Average that got a bull tag here yesterday. This was a pretty bearish near-term peak as the near-term line barely got into the reversal zone. The intermediate line is below its market sentiment, unlike the other 2 indexes we just looked at. and then the again, momentum line has bounced and crossed back above near term. So again, unlikely the near term line will drop, but it did drop further than the other indexes. And then finally, your Russell 2000, you can see looks very similar, right? Except its market sentiment line is not in the reversal zone, though its intermediate line is further up above it than all the other indexes, where it's just barely up above it. So that's kind of what we're seeing right now on the we're 3% above. Dark green shading and a green line across all the major indexes, even the Dow Jones, right, which got that bull tag. You got light pink shading right now, but you still got the green line because we closed back up above the moving average. So 1 day of bull tag, and as of right now, we've bounced off of it, right, so far. Right, we'll see what ends up happening by the time all is said and done. If you take a look at some of the other major assets, after getting a bull tag yesterday, the 10-year yield continued further to lower. So we haven't bounced off of that one yet. As you can see, we got the red line there to go along with the light pink shading. The intermediate line still is dropping, but it's still above the market sentiment line. Short-term sentiment is still subdued, so you still haven't really had that short-term bounce yet that I expect, according to that, we'd have pretty soon. The dollar index has dark pink shading and a red line for the first time. You can see the intermediate line has crossed below its market sentiment line, and short-term sentiment formed a bearish peak here, and really multiple bearish peaks, and is now turned over. So a little bit of a bearish, like we're starting a little bit of a bearish intermediate decline right now on the dollar here. That would actually be really bullish for equities. As you can see, the last time we were at an intermediate decline, the S&P went parabolic. So that would be a really, really good sign for the stock market if that were to be the case. The commodities continues to kind of just go sideways here. The intermediate line, the near-term line is crossed back down below the intermediate line. Market sentiment still oversold. Again, a big chunk of this ETF is crude oil, and that's actually still in a, this is why commodities is still kind of hanging in there, because crude oil is still in a dark green shading and a green line, and the short-term sentiment is bouncing. So everything is kind of coming up pretty nicely for this commodity, like commodity based asset. That's again the biggest component in that DBC ETF. Let's take a look now at the weekly chart that we see here. So let's look at the weekly chart on this, and you can see again a slightly higher close. Like we're kind of flirting. The higher close right now is at 51.06. This one's at 51.10. So we've got a, it's about the same. We'll see if it's going to be higher or lower by the end of the week. The size of the candle is definitely below the average. That's convergence there. So again, if we don't reverse on a dime, there's stages to that reversal, and that would be an early stage is the size of the candle being below its average, like we saw there. If we take a look at the 3 green arrow chart, which we need to skip, we skipped over that. We need to take a look at this one here. We do not have 3 green arrows on the S&P, Dow, or the NASDAQ. We still have the 3 green arrows on the Russell. So we're still in convergence mode. Pretty significant momentum decline on the diamonds. The MACD is bigger than what we see so far on the other two. We'll see if that leads into something more. Remember, the diamonds got the bull tag, which means we almost had 3 red arrows there. We didn't quite get that red arrow on the 30-day moving average. It became really, really close to one. If you take a look here at, let's see here, that's some of these other oscillators. Let's take a look at the 3 green arrow on the 2 line. You can see still above the 8-day moving average. The diamonds yesterday closed below the 17, stayed below the 17. That's important. It has not crossed below the 30 yet. The MACD and stochastics are below the moving averages, which are falling. So this, and there's a big gap. Like right now, the diamonds have by far the poorer margin of safety than all the other indexes. Right, there's plenty of volume there, but the diamonds has a bigger gap in volume and a bigger gap between the moving averages that we see here. So if we were to break that 30 and the 50, that's a big move to the downside before we get down towards the 200 there. IWM, you can see is easily above the 8-day. MACD is above its moving average. So nothing too alarming. We're still maintaining a bullish trend. That's the case for the DMI. Still bullish. The negative indicator almost got back below 25, still above it, which is again crazy with the positive as high as it is. The RSI and the CCI are still at bullish levels, above 60, above 0 on the CCI down there. The Ichimoku cloud, we're still way up above the cloud. We haven't reached the 20 level yet. We're still, trading around that 19.5. But again, we haven't dropped to 0. Once we drop to 0, and if we were to break the green line, and then especially if we were to break the blue line, usually that's when the trend breaks, is when we break the blue line. Nowhere near that, and way up above the cloud, and a very strong rate of change. It's nowhere near in danger of ending. We're still in the upper quartile of the bandwidth. We bounced back up into it yesterday. Momentum is declining, but still pretty strongly bullish, and we're barely below the upper Keltner channel. So no signs at all yet that anything is changing here. Of course, the diamonds is the closest. The diamonds is trading below the midpoint of both the Bollinger Bandwidth and the Keltner channels. The momentum is far weaker on the diamonds. So if there's anything that is showing a sign of weakness more than the others, it's the diamonds right now. If we take a look at the 4-week range for the S&P, you can see we filled in the gap from yesterday in the morning. We talked about that being a common gap. We filled that in. And we've got a common gap today that we most likely will fill in sooner rather than later. So we did not get a new high point. In the last 2 days, we haven't got a new high point. But we're still easily in the upper range. In fact, you can see like we've been above the upper dot because the dotted line here, which is the midpoint of the range. If you look at that over the course of the last 20 days, you can see we've only dipped since we crossed up above the midpoint in the beginning of November. We've only spent 1 day barely below that dotted line, and that was January the 17th. We, of course, bounced back up above that going into options expiration, and we've been above the midpoint and in bullish territory for most of this time. But we are barely in the upper reversal zone now, so let's keep an eye on that. Remember, the diamonds are the ones that's the closest, that's showing more signs of weakness. It did get below its midpoint of the 4-week range yesterday, and it's still below it even today. Barely, but it's still below it. And the moving average of this is starting to drop below the 80th percentile as well. So again, the diamonds are showing some signs of weakness that we're not quite seeing anywhere else quite yet. If you take a look at the 3 green arrow chart, you can see average volume, below average range. So at least it was big enough that we haven't continued to drop further, at 87% or 0.87%, excuse me. We're still we're not as extremely low as when we were closer to 80%, which is the extreme. And then you can see the volume seems like it's found a low point here at its 52-week lows, the 20-day average, 52-week lows of the 20-day average. So it looks like we're trying to base here. Now, granted, if these lines go up, that typically coincides with weakness in the market, as you saw here. So it's not necessarily that we want these to go up too significant. And if it gets back above 1%, that's generally when we are in intermediate decline. So we since we're below 1%, we want to stay below 1% as long as possible. Unfortunately, we don't generally stay below 1% for too long. You can see, like in 2021, we had a pretty decent period. 2017, we spent the whole year below it. But then we saw what happened in 2018, right? And then eventually we were below it again for a good long period of time in 2020, 19, 2020. And then we saw what happened, when it corrected. So we want to stay below it as long as possible. But the problem with that is the longer we stay below it, the bigger the volatility is that comes out of it. So it's kind of a catch-22 there. But since we're below it and we're bullish, let's try to be as bullish as long as we can before the reckoning comes. All right, now let's take a look at the volatility index. And you can see after getting above 15 briefly yesterday, which again, it's like the first time in a while that we were above 15 again briefly yesterday. We closed above 15 a couple of times here right before and after options expiration, but nothing any more than that. You can see obviously closing right around 14.5. Both of these last 2 days. Though the VVIX has jumped up above 80 after being at extreme lows there. I remember we're also back above the 90% mark. If you look at where we are relative to its average values, the VIX almost briefly did get above the 200-day average, because remember the 200-day average is actually below. So, again, it appears that we are headed towards, an increasing volatility. Now, is this as high as it's going to get because the 200-day moving average is here? Because when you get above the 200-day moving average, you're typically in an intermediate decline for the volatility index. So it's not that far away. So is this the peak? Is this how much we're going to rally? It's unlikely, but it's very possible. If you look at the weekly version of this, again, you can see how we're above the 17-week moving average. Getting above that 30 and 50 is usually when we're in an intermediate decline. And you can see if we were to get above the 50, which is essentially a proxy for the 200, then how big of a gap there is to move up towards its 200-week average value. Of course, getting above that now, you're looking at more of a correction than just a standard pullback, as we saw pretty much both these instances here in March and over here. Now, we were still above it there in 2022 on that last move, and then we had a couple little intermediate pullbacks since then, and especially with this move here, but nothing back above the 200-week yet, and we'll see. This is, again, one of the bigger gaps below the 200-week that we've seen in a while here. If you go simple and simple here, you can see just how low it is. So if I were to kind of increase that so you can see it a little bit better, and let's go out for some context just on how big that is. Again, this dotted line represents the low point, or pretty close to the low point. Looks like 46.39 was the actual low point there. So minus 46.39. That's as low as we got here during this particular intermediate decline. And that's the lowest that we've been since 2013 at the beginning of the QE3. So it's been a while. And you can see we got about that far down here too. When the 200-week moving average was just crossing below 20, like it is right now, going into 06 and 07 again during Fed rate hikes and the end of the rate hikes, which occurred right here in June of 06. And then we started to have a little bit of an increase in volatility going into ultimately the beginning of that bear market that happened at the end of 2007. Sounds familiar, doesn't it, in terms of the macro picture that we're looking at right now. All right, if you take a look at what's driving the price action, again, continues to be weakness in the dollar. Remember, the dollar potentially beginning an intermediate decline now. Weakness in commodities that is forming their base. Look at that big breakout there in gold over the past so many days. Let's take a look at just today. So we'll look at March the 6th. And you can see gold still did pretty well today, outpacing pretty much everything except for international equities. The dollar was down significantly today. It's a little bit of a difference from what we've seen. Again, you have to go back to, let's see, was it last Wednesday that gold had its first update. And then it's been up now over the last, 6 days, almost 6%, 5.75%. The dollar having its biggest down day during that run today. Real estate and bonds are still up over this period, up 3.25%. So again, kind of a risk-off move from that perspective. And you can see stocks are only up 0.5% over that 6-day period. At least the S&P and the Russell kind of in that frame. The Qs are only up about 0.25%. And again, coming off of where they were down at negative levels at the end of the day yesterday. So a little bit of about as much of a risk-on move as we can have, considering that the markets have been so bullish here. Again, looking at some of these other assets, we looked at the dollar breaking its 200-day moving average today, still holding its 50-day average. MACD and stochastic's pretty negative there. We also talked about the 10-year yield also breaking its 200-day, still holding its 50. So really important levels right here for both those really important asset classes. Breaking those levels would be really, really bullish for equities that maintain. Holding those levels for support and bouncing obviously would ultimately have the opposite effect Crude oil still trending up. You can see now the 8 and 17 crossing of the 200. I mean, it's a very orderly move. There's no volatility in this move whatsoever. So very, very small. In fact, if you look at like the Bollinger Bands here for crude oil, you can see there's not very much of a move here. The band width has come down to its way down to its 152-day lows. So very much of a grind and well inside the Keltner channels. So crude oil is setting up for a squeeze type play, a play where it breaks out of this volatility band, this very, very small volatility band, significantly one way or the other. Again, we're right on the edge of that $80, which is a very important level for crude. Getting above 80 would really be a significant move higher. Again, well above. It would be a significant move above the 200 day average, but you can also see it'd be getting back above the 30-week moving average after bouncing off the 200 and crossing, and the MACD crossing. It would suggest that we're going to be bullish for a while here. And again, the last time we had a good, strong bullish trend in crude, that coincided with our last intermediate decline in equities, and as well as an increase in yields. During that same time frame as well, right? We had a little bit of an increase over here. Sorry, we had a little bit of an increase in yields during that 3-month period as well, going into the end. In fact, we got all the way up to 5% on yields, and the mortgage rate got up pretty significantly, up to 8%. So that's the kind of macro picture that would suggest bring into the possibility of this, an increased possibility of a intermediate decline. The difference between now and back then, back last summer when that happened, is we weren't so parabolic last summer. Like the ADX got above 43, but this time we got above 50, and we're still going. If you look at it on a weekly basis, last summer the ADX got to 29, and we saw what happened when we came off of that semi-parabolic peak, getting above 30. Well, this time the positive indicator got above 37, almost to 38, or almost to 39, almost to 40. The negative indicator is back below 10, just like it was last summer. But this time the ADX is a much higher, much higher. So again, a lot more to consolidate than what we had last summer, and that's what the consolidation looked like last summer. Let's take a real quick glance at how the sectors performed today first, and then we'll take a look at another time frame here. Let's start with just today alone. And you can see utility started the day really strong, along with technology. Materials kind of jumped up here, and then you saw healthcare also kind of joined the party. Energy jumped up really big. Energy ended up pulling back. Communication services and discretionary underperformed the whole day. That's a pretty 2/3 of the Mag 7 there. You have utilities and staples and healthcare all outperforming today, which are considered safety trades, along with technology. Now, if I zoom out to that same 5-day period, or 6-day period now, that gold has been doing really well. Remember that real estate's done well, bonds done well, gold, so kind of a safety, a risk-off mode. You can see during this period, discretionary and communication services actually started that period pretty well, but they've really come down now, down 1 to 1.5%. Healthcare also down. It was up today, but off of like lows. It was one of the worst performers. Technology was a laggard up until today. Still is a laggard against many of the sectors. And you can see utilities and real estate, interest rate sensitive areas doing the best here lately, along with staples. And then you can also see energy, materials, dollar sensitive sectors also doing well. So not your typical risk on trade. And if you were to take a look at the 12 grid for these sectors, you'll notice here that, again, dark green shading, green lines all across the board. Communication services, which has been a very important component of this move, has got a bull tag. And then XLK, you can see, is really, after getting an overbought cluster, is really close to its moving average. And so is discretionary. Discretionary has had the biggest decline over the past few days. So a lot of these other cyclical areas still holding up pretty well, but your Mag 7 sectors are not. You can see the rotation coming out. If you look at the relative rotation graph here on a weekly chart, here, let's just update this. On a weekly chart, you can see discretionary communication services is right now, there's still the only leading sector, technology coming down. If you look at it on the daily version, communication services moving down to the left. Technology has moved up to the right, still only in the improving category, along with staples and utilities and real estate, all in the improving category as well. Energy and healthcare now are down to the left. Materials is still up there, along with industrials and discretionary. So those are the only three that are in the leading area, but they're moving down now relatively quickly. If I were to zoom out to just to kind of see how things have, like just a few days ago, let's see here. So that day, since that day started, when gold started to outperform, you can see technology and communication services were were underperforming, and you can see your safe haven areas, utilities, real estate, staples that were in the improving category. And since that time frame, right? So since that time frame, those three sectors are starting to lose a little bit of momentum. And technology turned back up, is now in the blue, and communication services is continuing with these other cyclical areas now moving. These are right here in this area right there, you can see they're all moving down to the left right now. So financials and materials, industrials, you saw energy, healthcare moving back. And so a clear change in what's leading this market, and it's moving away from the risk on and moving towards the improving areas, which are kind of your risk off trades. All right, that takes us to our trade idea of the day. Let's take a look at Kimberly-Clark in the healthcare area here. You can see the stock has been in a bearish trend for the first half of the past year, but then lately it's been in the real significant sideways action. A little bit of a breakout move going on here today. You can see a pretty decent move up to the upside, further above the moving average than we've been on any of this sideways action, up over 3% above the moving average, dark green shading and a green line there. Obviously, you have three green arrows on the chart. You can see the three green arrows. We've had three green arrows for a while here. A couple of those days with some pretty good volume too on the breakouts, and above average volume today on the move higher. You can take a look at the 2-line version of the chart. You can see we are the 8 and 17 day crossing above the 30, moving away from the point of control, moving up towards that 200-day moving average there, kind of breaking out of this volume node, breaking away from this volume node at least. Looking at some of these other oscillators, they're not as strongly bullish as what we've seen on some other breakout stocks, but at least we're at trending levels above 25, well below 20 on the negative indicator down there. The Ichimoku cloud, we are up above the cloud now. The cloud's really flat, but we're above the cloud. We got a positive rate of change. We have an intermediate trend strength trend going on right now. The RSI and the CCI are at bullish levels, well above 60. In fact, the highest level of this whole sideways action. And then we were above 150 earlier in this bullish move on the kind of the original breakout there. And you can see we also are pushing up against that upper band, not quite out above it, but at least pretty close in the 93rd percentile. And then you can also see we close outside the Keltner channel to the upside with a green dot and some increasing positive momentum. So what I decided to do here on this trade was to do a bull put spread coming out to a weekly option, so it gives me a little bit more strikes. The downside is that the spreads are pretty wide, but I was still able to get a pretty decent credit, about 55 cents on a $2 wide spread. So I'm risking my normal risk, $1,000. In this case, getting about 385 with my break even there at 121.45. So essentially, you can see we'd have to completely reverse this move and get back below the point of control and moving averages for us to get to the point where we're losing 385, which out of $1,000, that's about as much as I would be willing to risk on this trade and would want to get out of the trade at that point. All right, that wraps us up for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. And let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like me on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.